Hi everyone, how's it going? Welcome. It is 1 o'clock. We just got the closing bell and we had a really interesting day actually. So let's take a look and see how this day developed. Let's start with the daily view and just look at the overall candle. So what we see here is a large range. So about the same as yesterday, actually probably a little bit bigger range than yesterday after the whole week of having these smaller bars. So the fact that we moved up and out of that MA90 was unexpected. I was expecting it to stay within this range, the MA50, MA90. Instead, we got a movement upwards. So how does that change things? How does that change how we view next week and how things are going to move going forward? Well, it definitely gives us a stronger bias towards us moving up above that MA90 steadily. The only trouble is that we haven't had a pullback this entire time. Can we call this red bar right here pull back to the MA50? Sort of, but it's not really like a it doesn't really provide a lot of relief inside the market, especially given that the volume was only so-so, right? It wasn't super large. So today we also are on low volume. So actually all week we've been on this low volume, and that gives me pause. That combined with the fact that we just kind of sort of pulled back the MA90, we didn't even really come and touch it, and we just went forward went upward and on low volume and on a holiday Friday. So what I'm concluding from this and what I'm looking at it as a higher probability event is that this is just still being ready to pull back. Now we're maybe thinking that pull back again to the MA90 or MA50, maybe to the EMA20. At this point, those two levels are very similar. So you're still thinking pullback. And the reason why is that uh, thin volume. If this volume was up, I would think differently. When volume is low, it is a lot easier to manipulate markets. When you have low liquidity, low participation, low flow, you have a heightened potential for manipulation by large institutions. But these days, we're not really thinking large institutions. We're really talking about algorithms. So what do algorithms like to do? They like to take out all the stops. Okay. So if a lot of people were looking at MA90 and saying, hey, I think we're going to go down, we're going to short. And if I short this MA90, then uh, then I'm going to hang on for a bounce and a pullback, and then maybe I'll be out. So, and that's sort of similar to what we were thinking, except we never said short the market, right? We just said, let's wait for it to pull back and bounce. So there are people who did short over here. A lot of people were looking at the same level, the same thing. We have horizontal resistance. We have the MA90 right here. Let's see if it goes up and touches it and then pulls back. And so there's a lot of shorts right here. And an algorithm was going to try to take out those shorts, meaning we're going to allow this market to go up higher. And then all these people have to stop out of their shorts. And if they do that, then the market goes even higher. And then that is when it actually pulls back. So people, those shorts lose money, they flip around and go the opposite direction, losing some more money or make it so appear to be making money. But then that's when the real pullback happens and they actually end up losing money. So I'm really wary of algorithm right here. I'm not 100% convinced because of this low volume, not 100% convinced of this breakout movement above the MA90. So what will I need in order to be convinced of it? I need the volume back, right? And I would like to see a low above the MA90. One day would be great. 2 days would be super. And then I'll be convinced that this can move forward. So the entire 2 weeks, or especially this week, very low volume and moving up. This moved up parabolically, gapped up a couple times, and then started moving upwards again. And that is not a normal pattern for markets to move in. But if we pull back and then move up, that becomes a normal pattern. If we just keep on going up, that is not a normal pattern. So I'm looking for normalcy inside the market. I'm looking for things to move the way they normally do on normal amounts of volume. And until I get that, I'm not going to be convinced of a particular movement or particular direction. So next week we'll tell. We'll have a much better idea next week, especially if we start to get market participation again. And then we'll see, are we going to pull back to the MA50, to the EMA20? By the time we get there, are they actually the same level? And then if it's weaker, do we pull back to this 50% retracement before we move upwards? Or am I just completely wrong about this movement this time? And we break out, and if that's the case, no sweat off our backs, because we actually never went short. We would just wait for it to pull back, and then we would enter. Because what I'm 99% sure of is that we're not just going to go like this straight up. Okay, that would be really, really unheard of. So what would be fine is if we did something like this. Okay, that would be normal. This would be abnormal. So for this upward momentum to just never die off, that would be highly, highly, highly unusual. And I'm sure if we look at momentum indicators and overbought, oversold indicators, we would see that we're still in a overbought situation. So let's do that. When I look at my RSI 5, we are very near the top right here at 76.25. That is nearing overbought conditions. If we look at this at RSI 2, we're definitely at, which one's the RSI 2? MFI, money flow indicator, overbought. RSI 2, overbought. RSI 10, overbought. So, or at the verge of being overbought, we're very close. So maybe a little bit higher, like I was saying, an algorithm would let this market float a little bit higher and suck people in before coming down. So we just really, really want to be careful of a bull trap. I could be wrong and we don't get that bull trap, but it doesn't hurt us to be more cautious and say, why don't we wait for this type of movement instead of being hasty and coming right here and entering the market and then risking this. Okay. So either I'm going to wait for either this point right here or this point right here before I start going along this market. Overall, yes, we do expect the market to go up, but we want a safer, higher probability entry. And if we wait for these points, options prices will be lower anyways because of the volatility crush that we get when we pull back and move downwards. All right, so hopefully that makes sense to everyone. That's how we're looking at the market at the moment. Let's take a look at QQQ. QQQ, very strong. Okay, so that's a big bar movement today, clearly bigger than yesterday, clearly above this horizontal resistance, which we were at, but almost at this high right here. So that's even more reason why if I was so strong that I hit resistance today, that's even a higher indication that, well, I've got to be really strong and break out in order to break out, or we could consolidate here and pull back before moving out, which would be the much more normal movement. So I'm still looking for a pullback. It's still more likely that we're going to have a pullback and let the algorithms do their thing and try to suck people in and allow this to pull back before we actually make an entry. Okay. And let's take a look at bonds real fast. Bonds chopping sideways. right? And as long as we get bonds chopping sideways, that's good for the equities markets. Then they can resume or they can continue whatever that they were doing. If we see a downward movement in bonds, that'll put pressure on the markets, and then that would be the pullback, right? So it would be a bond market stimulated pullback, or we could get a algorithm bull trap stimulated pullback. Okay, so I think let's see how we did during the day. So what we said is be careful if we approach the MA90. So we did react off of these lines that we drew. You can see we consolidated at this one, consolidated at this one, bounced off of this one. And then the MA90, we hit it, we consolidated across it, then we went up, then back down. And what I said is if we hit that MA90, you're going to look for momentum or volume or a large bar to bounce back down. And we never got that. The market was strong. It just kept on going up. It bounced off of the MA90 right here. We don't see any large red bars. We don't see any volume spikes. And it just bounced off of that MA90 again and actually started to move upwards. So that is strength in the market. But again, we can't completely trust that strength because there's no volume across the entire day, except at the very, very end where we got a little bit of a spike going into the weekend. It's a little bit surprising that it was so strong into the close, into the weekend. That's very optimistic of the market to end this way, but that just gives me even more reason to think there's a setup here. Algorithms are just trying to suck people in. So I'm going to stay away. I'm going to be really cautious. And if I'm wrong, then once again, no sweat off my back, right? I'll just wait for that pullback. Okay. So it doesn't hurt me. It doesn't hurt me to be cautious. I'm not losing out by being cautious. All I lose is a couple days in investment time. So if this is just going to go up and come back down, then all I miss is this movement right here. So it's much better than going in and then saying, okay, now my money is trapped and sucked in, waiting for this entire time before I start to make money. I'm saying my money is safe until I reach this time before I start making money. There's a difference, right? Net, it seems like the same result, right? If I brought this line over here so that they crossed at the same point, I said, Kane, well, if we end up here anyways, does it matter that my money was in here, that I stayed out and just started at this point and went up, versus if I went in and then I went up, and then, or if I went in right here and it went up, pulled back and it went up? Is there a difference? And the answer is yes. Even if there wasn't a money difference, which there would if I'm playing options, because there's a time value difference right here. And there's also, if I move up on here, I'm doing it on increasing volatility, then increasing options prices. So I'm still paying a little bit more than if I waited to down here, or if up here, they might be the same, because on the way up, the prices would probably be similar because they're both upward movements into the same price area. But more importantly, it's psychologically. Psychologically, number one, I lose utility of my money during this period of time, rather than just having my cash available to go into opportunities and move upwards right here. I lose liquidity of my money during that time period as well. And then psychologically, watching my money or my investment go all the way down before recovering and then make money, that is very different. So actually what ends up happening to most people is they would enter right here, they watch it go down all the way down to here, feel really bad about it, and then when they came back to break even, they'd be so excited they sell out of that position. And that was when they would have made money. They sell exactly at the point where they would have made money. So yes, psychologically, there's a huge difference because that most people get sucked into that mentality. Oh my gosh, I broke it. That's why uh, prices get revisited. That's why we can draw a horizontal line like this, and we see prices continuously react to it. It's because people have psychology that says, "Oh, I broke even. Oh, I'm okay now," or "Oh, I got hurt at this level before," and they react instead of looking at the actual situation and saying, "It's actually the exact same thing situationally." Okay, except for the time value and the other things that I listed. If I was playing the equities, then situationally it would be the same. But for me, it seems like a big relief because I watch it go down and come back up, and so I just exit. Okay, so psychologically is very important difference. Okay, and let's see if there's anything else to look at. I don't think so. So we're just waiting over the weekend, see if anything happens. Wait for a Monday, see if we get volume back, and then other than that, um, basically just waiting. Okay, so this morning I was explaining about the bond yield and what happens at auction. If the auction doesn't go well, why does that drive yields up, and why does that make prices go down? Um, I think that was a good enough explanation. I didn't do exactly the math calculation, and I can do that now, but um, if you guys want to. Is that something you still need to see, or is the explanation this morning good enough?
Please do another explanation.
Okay, great. So I will do that. So let's go to our Word. I don't have my pen tab ready on hand and attached, so I'll just type it out. So if I have a bond that I paid $1,000 for, and bond auctions you always pay the face value because the government needs to raise a certain amount of money. So let's just say that the government wants to raise $1 million. It needs to raise a lot more than that, but we're just making this simple. So, and let's say last week before a coupon payment, I bought $1,000 bond, and I paid or I received 5.5%. Okay, so every year I'm going to collect $55 on my $1,000 that I invested. And this week the government needs to raise $1 million, and that means they're going to sell 1,000 bond, 1,000 face value bonds. Okay. And so they start out where they did last week. And they say, okay, I will offer you bonds at 5.5%. And let's just say only 100 people decided to take them up on it. So they still have to sell another 900 bonds, right? And so they go to 5.75. They usually don't jump in such huge increments, but this is just an example for us. And so we say, okay, well, maybe 300 people or 300 bonds are sold at 5.75%. And then we get to 6%. And then let's say another 500 bonds are sold there. And then now they still need to raise 100,000. So they go up to 6.25%. And here they are able to sell the remaining 100 bonds. Okay. At the end, the yield of the bonds, they're this. Okay. So forget about my bond. What about these people? They bought on the same day, they bought 100 bonds with a yield of 5.5%. And this guy over here was able to buy the same bond and for their same $1,000, they're able to receive 6.25%. So if this guy goes, hey, well, I want my money back. Maybe I don't want to hang on to it for 30 years and wait for my money to come back. I want to sell my bonds. Anyone who's looking at this right here, or even the same person who wants to buy more bonds, they're not going to pay $1,000 for this bond right here. Because they would say, why would I pay $1,000 for this bond when I could approach these people and say, hey, can I buy your bond for $1,000? Right? And if these guys just bought it for $1,000 and they're say, hey, well, are you willing to let go of your bonds? You know, most likely these people would even say no, right? So you would have to approach these people right here and say, hey, maybe I'll pay you $999 for your bond that you literally just bought. And say, okay, well, I made $1 in 2 seconds. Why not? I'll do that. I'll buy your bond, or I'll sell you my bond for $999. Well, if this bond wants to get sold, it has to be sold for less than $999 at this point, right? Does that make sense? Because it's not paying as much as this one. And if this one is worth $999 or $1,000, this one cannot be worth as much. It has to be worth a lower dollar amount. So how much is this worth? Let's make this easy, and let's just say the 6.25% one is still worth $1,000. Okay. So if a 6.25% yielding bond is worth $1,000, then a bond that is at 5.5%, it must sell at a price that gives the same yield as the bond above. Okay. So this one, it's easy. It pays 6.25%. The yield is 6.25% because it's being transacted at $1,000. There's no change in price. So how much does this 5.5% bond have to be sold for in order to yield 6.25%? Okay. So this $1,000 bond, after 1 year, it should turn into $1,062.05. Okay. So the question is, at what price for the 5.5% yielding bond, okay, do I get the same yield? Okay, so if I say, okay, so I would take the current price. I'm going to blank on my math right here. So I need to get the same yield out of 5.5%, or sorry, yeah, 5.5%. So $999, if I go to Okay, so I need to make up for it. So here, if I don't sell it, if I hang on to it, this 5.5% bond becomes $1,055. So there's a difference here. Okay, so for this bond, $1,000 becomes $1,055, and so there is a yield difference here. And so I take 1,055 divided by 162.5. Okay, and let's see what that is. Okay. And then I need to discount my did I do it the other way around? Yeah, I did it the wrong way around. I need to do this. Okay. And then I take my $1,000 and I divide it by this. However, $1,000. No, $1,000 divided by 106.1062.5 times 105. There we go. So I have to, in order to get the same yield out of this bond, I need to transact at $992.94. So this bond here is now worth $992.94. Is that the right number? Yeah. Okay. So if I sell this bond right here at $992.94, then the person who buys it at $992.94, they get a 6.25% yield on their money. And then, and so that's the same yield as the new bond, which is, the only difference here is you invest a little bit less cash. Another way of doing that, let's just see, if I do the 99294, if I take this times 1.0625, okay, you see that? That became 1055. So I just did it slightly out because I was trying to figure it out in my head. I went a roundabout path, okay? So if I pay $992.94 and I end up with $1,055, that means I made 6.25% on my $992.94, which is the same as if I got $1,000, ended up with $1,062.05. So these two situations have the exact same yield at this point. And so if I say, hey, do I prefer a to pay $1,000 for a bond that ends up paying me 6.25%, or do I prefer a bond that at $992.94 that pays me 5.5%? The answer is there's no preference. They're the exact same. They give me the exact same return on money. And so because of this phenomena, that's why dollars prices go down. So if an auction goes poorly, meaning that I can't sell in the bonds that I need to sell, then the yields start to go up. So that explains why yields go up. And then the calculation I just showed explains why bond prices that already exist in the market, which is all this stuff, right? There's a TLT, there's a history, meaning they already exist, and the new issuances are brand new. They're all exactly $1,000 face value and $1,000 value bonds. And so every other bond that exists has to make up for that difference in yield and also the difference in time. So I took it in order to make the calculation and example simpler. I took time out of the equation by comparing bonds that were issued on the exact same day, right? So that's why prices go down and yields go up if an auction goes poorly. If an auction goes really well, then what that would look like would be if the Treasury was ready to sell bonds at 5.5%, but they see that it's oversubscribed. I'm trying to raise $1 million, and before we even start the auction, I've got $2 million worth of bids saying that they want to buy it at 5.5%. Well, if the Treasury sees that, they're not going to start at 5.5. They're going to try at 5.25 or 5.00, right? They're going to start at a much lower point. They'll start 4.75 and say, who wants it? And then maybe 100 people want it. And then they'll say 5.00 and then see how many people want it. And maybe, 700 people want it. and then 5.25, then they get the remaining 200. Okay, so that's how a really good bond auction would go, and then a very poorly bid bond auction would go this way in the direction that we just had the example for. All right. Was that clear?
Yeah, yes, thank you.
Yep. Okay. You're very, very welcome. All right. So that'll be it for today. There will be no weekly market review this weekend because there's nothing to say. The market went sideways the entire week. So no market review, and I will see you on Monday in the pre-markets.